Hello and welcome to Trading with Technical Indicators. My name is James Boyd. Today's date, January 12th. Someone actually mentioned is wintertime where you are. There's no wintertime where I am in Salt Lake City. Mowed my grass about 10 days ago. So let's keep it that way. We also have Scott Thompson with us in the chat. We welcome him as well. And we welcome all of you here today on this Monday. Now just real quick heads up. We do post educational content on X. There is my handle at James Boyd CS. Quick reminder that we've been really following a series, okay? And this series started back on December 18th. Now, I'm only going to do this once for the year. The rest of the year, we'll kind of do what we normally do. But I want to kind of kick off the year with a series of strategies. Look, you can know all about different types of indicators, but where the rubber meets the road is that you actually have a strategy to use for the indicator. That's what we're talking about, okay? So really, what strategy, when you actually trade the indicator, what strategy are you going to use and why are you going to use it? Now, quick reminder that here we are on today's date, January 12th, talking about long synthetics, which is buying a long call and a short put together. So when I say a long call, buying that and then selling a put, okay, two bullish single option strategies. We'll talk about that here today. These strategies that we talk about, these are bullish in nature. So you might already be a bullish person and you might say, hey, these are some of the tools in the toolbox that the bullish investor might use to try to take advantage of a shorter term type of trend, intermediate or long term type of trend. Now, the two things we actually mentioned we were going to add to this, at least we talked about circling back to caller management. And then also we talked about kind of summarizing these strategies. When might the investor pick certain strategies and why? Should just know that those are on tap. But I'm showing you the post that we actually did a month ago. So let's go ahead and hop right in. Now, remember with what we discussed, the information here is provided for general informational purposes only. Also want to give us a quick reminder that the options carry a high level risk and are not suitable for all investors. When we talk about, let's say, multi-leg option strategies, those can involve multiple transaction costs like buying the option, selling the option, etc. So be aware of that. Short options can be assigned at any time. That's applicable to really this strategy because we're selling a put. And also remember that Schwab does not recommend the use of technical analysis as a sole means of research. Can be a starting point, but that doesn't necessarily mean it has to end there. And also remember that the paid money account that we set up about a month ago, it's done for educational purposes only to practice engaging in simulated trading. It's helpful, okay, to learn. And also remember that investing involves risk, including loss of principal. So let's go ahead here and hop right in. Now, the first thing I want to do is just real quick is go back to kind of like the sheet that we talked about. I'm just kind of using Excel as a place where we can write something down. It doesn't have to be on Excel. And remember, we kind of talked about your goals, okay, because that's the most important. It's your goals, not mine, okay? What are your goals for 2026? Just because the year changes doesn't mean your life is going to change. It usually starts with the person, okay? Second, we want to kind of think to yourself, what strategies are you going to focus on for 2026, along with using indicators? Now, we talked about these different types of strategies, right? Trend, swing, and you're going to see that I just kind of wrote those there. Today, we're just going to kind of add right here, long synthetics, okay? And we said also down below, we're just going to add a little tab there if we wanted to, make them where they're all nice and written down on the bottom there. We can just click on them. And this page would actually just be the long synthetic plan. So this page would be the trend plan down here at the bottom. That would really be swing. So what this should really look like at the end is each one of these tabs really becomes your sample plan that you would like to consider for yourself, okay? Now, let's go into this. So first off, when we talk about a long synthetic, okay, just want to break this down just real quick. And we're going to look at examples along the way. Long synthetic, not X. And let me actually change that. And what we want to do here is we're just going to define that. It's just a long call plus a short put, okay? Now, how many of you have ever bought a long call before and said, geez, I just really don't like buying a long call per se. I like the unlimited upside, but I don't like the time decay. I don't like the fact that I got to pay for it, among other things. The short put, you might like parts of it. You like the fact that it is a credit, it's an income. You don't like the fact that it could actually go down to zero. Like the stock could go down to zero and there is assignment risk. So what we're trying to do is we're trying to take two single bullish option strategies, okay, and combine them. Now, when you do that, you actually get, in this case, you get both the long call. So the long call is delta positive, which means the bullish position, and it's also theta negative, okay? But it's actually vega positive, meaning if volatility actually went up, the option price could increase. All right, now we got to define that short put, okay? So when you combine them, what is it really doing? The short put, is it bullish or bearish? So when I say bullish, I'm saying delta positive. If it's bearish, I'm saying delta negative. Well, it'd be delta positive. Theta, what would it be? Does it collect money from time to date, or do you pay? Well, you get theta positive. And what you're actually going to see here is if you sell something, whether you sell calls, sell put, it's vega negative. Now, it's kind of interesting. So if you went back and kind of isolated this out, you're going to kind of notice that these two kind of wipe themselves out. These theta kind of wipes itself out. So what are you left with? Delta. So really, when you look at a long synthetic, it is really two single options, okay? And you're trying to actually make money from the upward direction of the stock. Now, the biggest actually thing is I want to kind of point out here, how many of you actually have seen more bullish trades than you have money? Anyone? Anyone? I think so. So why would actually someone consider this strategy? They're actually trying to get leverage, okay? What happens is it's sometimes so easy to go through your capital that you have, and the investor is really trying to get leverage. Now, what I want to do is just real quick, I want to kind of start with an example as we do this, okay, if you don't mind. Now, the one thing I want to kind of do is, so when I say leverage, what do we mean by that? Let me show you what I mean. Now, we know over the last couple of weeks, we've kind of been mentioning, and I'm going to start with a lower dollar stock on purpose. I'm going to start with a stock like FCX, okay? Now, if we actually looked at FCX, and let me actually just, there we go, FCX. Let me actually change that. This is from Friday, so let me just kind of take that off. Let me put this right. Let me go to Dow Jones. There it is. Okay. Now I'm going to use FCX as an example. And what I'm going to do is I'm going to start with a lower dollar stock on purpose. Talk about the pros and the cons of doing different dollar stock prices. Well, if I pull up FCX, of course, if we're going to do a bullish position, we want a bullish type trend. So when we look at a bullish type trend, we're going to ask ourselves in the last 1 to 3 weeks or so, do we see a support level? Is it horizontal or diagonal? If this trend is actually going up, we really, in this case, have a diagonal support, which is really made from higher lows. Over the last couple of weeks to months, there's been an upward trend. Now, if I hopefully have taught you anything, we want to wash our mouth out with soap if we ever use the words, it's too high. Oh, don't ever say that, okay? Because remember, we said if it's hot, if it's at a high, that's a confirmation of the upward trend, okay? Now, what we're going to do is so when we talk about bullish trades in general, we want to think to ourselves, what indexes are going up? Which ones are they? Are there any indexes that are stronger than others? Second, are there any sectors that are stronger than others? And inside those indexes and sectors, are there any stocks, for example, that are showing an upward trend? Now, if you look at base material of the sector, and if you looked at the prices of gold and silver last night that I posted about, and we talked about, it's not kind of surprised to kind of see some of these material stocks going up, okay? Now, what I want to kind of do is when we talk about bullish trades in general, it always comes back to the same thing, which is we're looking for bullish bounces, known as acronym close above the high of the low day, close higher gap, which we said kind of those 3 words of the day, close higher gap on Friday, on our class on Friday. And of course, when we actually say those are the bounces, breakouts, which could be horizontal or diagonal, and we could also include there, if you want to, let's say moving average crossovers, which by the way, those could be bounces or breakouts, but we'll include that, okay? Now, I want to kind of talk about just real quick the structure of this trade. So first off, you can do what's called all at once, okay? Or you could actually do what's called leg in, okay? All at once means we're just gonna buy the call and sell the put together. If someone says, look, I'm gonna leg in, I'm gonna say this is a little bit more advanced, and most likely, not always, most likely, someone might do the short put first, then add the long call, okay? And you're probably trying to do a short put first when the price is down near the horizontal support level, and then you're getting the confirmation of price and you're adding on the long call. What we're gonna focus on first is just doing it all at once, okay? Now, what we're gonna do is gonna go to the trade tab. Now, if we do a trade here, let's go to the paper money account. We're gonna go to the trade tab. We're gonna do a trade, gonna go to the trade tab. And what we're gonna do in this case is we're gonna type in FCX, okay? Now, if I type in FCX here, what you're now gonna notice is, let's talk about the expiration month and the strikes and what this trade looks like. Now, if we looked at this, if we talk about, let's say, the expirations, that 20 to 50 days to expiration, okay? Think of this as short-term time frame. Are there any investors here that like that 20 to 50 days? Now here, when I say 20 to 50 days, that does not mean you have to hold on to it for that long, but that's your starting point. Now, when we actually say this 20 to 50 days to DT to expiration, okay, we're talking about looking at the monthly options, okay? Think of this as short term. Who here is short term? I'm not saying that's bad. Someone might say, James, I'm not short term. I like to look a little bit further out. We're going to still look at the monthly options and think of this as a little bit more intermediate. We do not want to go farther than 100 days out because we're selling a put and we are trying to get time decay. So really in both of these, if we said, I want to be short term, 20 to 50 days. If I want to be more intermediate, 50 to 100 days, okay, on the monthly options. Since again, we're actually buying the option and selling the option, we like to see the option width between the bid and ask narrower than 20 cents. You could think of that as like max. Now, is that always going to be the case? Not always, but you're trying to get that. Liquidity can change. Spreads can change. But that's important because you're buying something and selling something, okay? Now, when we talk, now just real quick, if we pick the same strikes, delta equals 100. If we actually pick different strikes, delta less than, okay, less than 100. So I'm going to kind of start off with this. But in our example here, we're going to kind of like show some differences. That's the way we learn, okay? Now, if we kind of said to ourselves, what else has a delta of 100? Well, if you bought 100 shares of stock, okay? Now, how does this differ than stock? Well, first off, it has an expiration. Second, it's a long call and a short put. Third, you actually have option pricing. You have different factors like time and volatility. That's not the same in stocks. And we don't have the right to the dividends, okay? We have a right to buy the shares at the strike price on the long call. We have an obligation to actually buy the shares at the strike price for the short put, okay? So there's differences. Now, what I'm going to do is I'm going to come back to this, and we're going to go look at, let's say that, right, go back to what we wrote down, 20 to 50 days to expiration. With those 20 to 50 days to expiration, what you'll now notice is we have in this case, that shorter term, okay? We're going to go look at, let's say that in this case, the 20 Feb. Now, if you said to yourself, well, what indicators is showing? Well, hello, right? Trend. Now, again, a lot of people try to make it really complicated. We have always said one thing from the beginning, and we will say it to the very bloody end, okay? We're looking for the 20-period moving average to be green. Why? Because that's a proxy for trend. We are looking for the shorter-term moving average, the 10, to be green as well as a proxy for momentum. Now, some people think they got to know 500 other things past that point, but the biggest thing is that is what we're looking for in examples of bullish trends. That does not guarantee that it's going to go up tomorrow, the next day, or the next day after that. It's just showing at this moment in time, there is trend and momentum up until this point. We're asking ourselves the question, could that continue? Okay? Now, What I'm going to do is when we actually pull this back up, let's go to the trade tab. If we actually went, let's say, the first strike in the money. Now, why is the first strike in the money? Well, because we're trying to get some intrinsic value. Think of the intrinsic value like equity. Okay, is equity bad? Maybe not. Some people kind of like that. Some people kind of want something a little safer, if you will, but that intrinsic value or equity, it actually costs more. Okay. Now, what you're now going to notice is if the investor just bought the call by itself, let's show this, let's build the position. There is your long call. Nice thing about the long call is it's a defined risk. You can lose $540. Who has the right? The investor who buys it. We're going to put it right on the Analyze tab, also known for us as the Fun tab. Control yourself. And if we actually take a look at this, we're going to look at this on the chart, and it's going to give us a little diagram. This diagram used to confuse the tar out of me, but really that blue line is just showing a max loss. And this blue line right there, as I'm pointing to it, going up, 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 that is just really showing unlimited upside potential. Hallelujah! Okay, we like that. But the con is, when you look at this position, it has a delta of 71, so that's the first dollar move. The theta is negative. So this is like a pail, okay? You're holding a pail, bucket, and every day you hold it, approximately, in the bottom of the bucket, water is dripping out of the bottom. That water is called time decay, okay? Now, is that always going to be the case? It could change based upon volatility, etc. But you're going to see in this case, that's a big factor why some people might not like long calls. Because what happens if all of a sudden the stock sits there for 30 days? That could become a very expensive trade. Now, let's take this other part. Let's add it. We're going to go single order. We're going to go first triggers SEQ. And what we're going to do is we're going to sell the exact same strike. All right. Now, in this case, now let me take something off for just a moment, okay? When we look at that long call by itself, we can see what the break even is. And we can see that break even as 60.35. Okay? So if that stock is at 58.54, the stock would need to actually go to 60.35 to break even at expiration. Okay? Now, let's kind of add this. Wonder if we actually came back and actually said, okay, I'm going to right click on that ASP, buy, and then just do it together. Let's say we actually did collar synthetic. It's also known as a combo, okay? Now, if we looked at that right there, you're going to see that it's just like what we saw before, but just put together. How do we do that again? Let me show it again. Right-click on the ask price of the call that you want to buy. Right-click, buy custom. We're now going to go down to where it says not any of this. We're just going to come up to this buy section and just say collar synthetic. And it just takes us to the menu. You want to buy what? What type of strategy? Well, we'll say synthetic, and it gives us the debit. And when you look at the debit here, we actually notice it's 365. Why do we care? Well, because that actually goes back to, we have the right to buy the shares at 55. We collect actually the debit for 365. We pay that. And now you're going to see that it has a break even of 58.65. Do you notice anything? What do you notice? Now, when you looked at the break even of long call by itself, it was what, 60.35? But since we're selling the put together, it's actually 58.65. It's about $1.70 less. Why is that? Why is the break even less? Answer, it's because you're getting a credit from selling the put, okay? Now, can you put on this type of trade and then set a stop? Can you set a target? Can you individually manage the long call and the short put? Yes, yes, and more yes. Check liquidity. But the biggest thing is, let's say the investor said, look, I want to do this. How much money needs to be set aside? Whatever the max loss is, there it is. What's the commission? You're buying the call and selling the put, hence $1.30. And if the investor said, I want to do this trade, we're going to go ahead and send this order. Now, before I do that, let me show you what this now looks like, okay? If we analyze this trade, you're now going to notice that the line, when we take a look at this, let me take off that right there. Instead of it just being like a long call by itself, which was that, if we said, what does this look like if you combine a long call and a short put, the line is diagonal. It's the profit loss movement is similar to a long synthetic or vice versa. We talked about some of the differences. The profit and loss movement is, okay, the delta. Now, the biggest actually thing is if you take a look at this, what's the risk of this trade? Well, the risk of this trade is we like that upside potential, but dadgummit, if the stock actually goes down, the stock goes down, 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 and the stock could go to zero. And the risk of this trade is the investor has the short hat. Okay, now you probably already know where I'm going with this, but I'm going to stay here. What I'm going to do in this trade is I'm going to go confirm and send. And then what I'm going to do is send the order. Now, if we did the exact same strikes, now this is a pop quiz. If the stock goes up $1, how much should this position be up if it went up $1 from now? How much should it be up? Well, it should be up, in this case, $100. If the delta was 100, stock goes up $1, it should be $100. Wonder if the stock tomorrow goes down to $1.47. Well, stock movement $1.47 down times the delta, the conversion, should be down about $147-ish. Okay. Could it be different a little bit? Yeah, it could be. Sure. Okay. But that's really what we're doing is we're taking the delta, the stock movement up or down, times it by the delta. Okay. And then it converts that to what the profit or loss approximately could be. Now, what I'm going to do in this case is let's kind of take this one step further. Okay. Now, this is very important here. Okay. So when we talk about the position sizing, okay, a couple things I want to kind of write down here. First off, we have to define the portfolio risk, and we need to know it in terms of dollar amount, okay? And we need to actually identify the trade risk. And that trade risk, when I'll tell you what that trade risk, the dollar amount, okay? So if I said in this case, let's say I said, hey, we're willing to risk $750, and that trade risk was, let's say, 500. Well, this would actually tell us the number. It would tell us that we could do one contract. Are you with me there? So 750 was the portfolio risk. 500 was the trade risk. The position size or number of contracts would be, in this case, one contract. Okay. Now, when we talk about trade risk in this case is just going to be the stock entry price minus the stock stop loss. And then what we're going to do is we're going to times it by delta. So what this is going to look like is if the stock was at 100 and we have a stop loss, let's say at 95, what's the difference? $5. Well, if we did the exact same strikes, the delta would be 100. So what you're now going to see is the loss should be about $500. That's all it is. The difference in the stock price when you got into where the stop loss is, times it by the delta to convert it to the profit loss on the option, $500. Okay. Now let's do this just real quick. Okay. I want to actually come to another example, but I want to include this next piece here. Okay. Now, as I do this, let me see if there's any questions. Any questions that I missed that Scott has, for example, yeah. So P actually is going to where I want to go just right now. Let me actually so let's say the investor said, you know, James, I was kind of thinking about getting into a stock. Let's go to another one now. When we look at this strategy, I want you to think about what we talked about with swing trading and trend trading. Now, one of the things we talk about in swing trading is looking for stocks that are trying to break inside old channels. Well, one of the stocks, so if I were to ask you a question like, where do you see resistance? Calling all technicians, what would you say? Where do you see resistance? Now, if we looked at this and said, where do we see resistance? We could also ask ourselves, where was old support? You know, if someone asked me that question, I'd always be looking like the last couple weeks to 1 to 3 months. And there was a whole lot of support right in here, okay? And what you're going to kind of notice is we're kind of knocking right on that 72.5. Now, significance. Well, if it broke inside that 72, if it did, it might try to come to, let's say, that $81 threshold. Now, we talked about it ad nauseum. I mean, when it annoys me, I know I talk about it ad nauseum. We just saw one of these trades and it was labeled as BA. And we actually talked about this, and remember, there's some people talk about, well, I'm waiting for a pullback. I'll wait and see what happens next week. I'm going to search something else. And all of a sudden, the stock actually breaks inside this old channel, and then the person is just constantly searching. If you just probably looked at the Dow 30, NASDAQ 100 stocks, and the S&P 100 stocks, if you can't find anything in those three baskets, there's a pretty good chance you're not going to find too many other trades. Look for the ones that are liquid ones that are probably on the indexes. That'd be a great place to start. Now, let's go back to XYZ. Let's include this next piece. So how many of you don't like this strategy where the risk is all the way down to zero? All right, so how do we fix that? Or what's a potential solution? Well, it's just like what we talked about with a cash secured put. And this is where the strategies build on themselves. So if the investor said, James, I'm going to buy, and I'm doing this on purpose. Okay, notice right here, if we look at the first in the money strike, it's 25 cents wide. Now, does the investor have to buy at the ask price? They don't have to. It doesn't mean if they put a lower price, it's going to get filled. Okay, so that's true. So let's try to put maybe like an order right here. I'm going to click on that right there. And what I'm going to do is I'm going to try to get in where maybe we're not paying as much. The mid price showing 460. Is everyone with me? So what we're doing in this case, we're saying, look, we're going to buy a call. All right, that's not too bad, just a single option order. Now, but how do you add that second piece? Well, we're going to come down here and say single order, first triggers SEQ. What are we adding? Well, what we're doing is we're going to say, look, we're going to sell the 70 like we did in the previous example. But what we're going to do is we're going to buy a put just like we talked about with cash secured puts. We said we're going to buy a put with a blank delta or less. What was the number that we gave? We're going to sell a put, we're going to sell the put and then buy a put with a blank delta or less. Well, the answer given, if we fill in the blanks, it was a delta of 10 or less. Now, what you're now going to notice is, so if we said, what indicator are we using? What indicator are we using? Well, we're still using that shorter, those whole moving averages. Boy, those have been very interesting lately. Now, again, a lot of people are like, yeah, I'll just wait and see if it breaks resistance. You're missing the point, okay? The point is, if we're making higher lows into the area of resistance, and if you see 1 day pullback, 2 day pullback, and I've said this more than once, okay? If you see pullbacks of less than 3 days, pullback days being red candles, and if all of a sudden you start to see green candles after only 1, 2, or 3 red candles, and then all of a sudden we start to make like hammers, piercing lines, bullish engulfing, close above the high of the low day, why in the world would technicians be making like, let's say, higher lows into resistance if they didn't think the price could break above resistance? That's the point. Now, you're also going to notice that there's a little gap right here. So if there's been any bears in this trade, they might say, oh, dadgummit, followed some guy on the internet. He said everything is going to go down, okay? You get these people, right, where they just talk about everything is going to go down. Everything is going to go down. They've been wrong for years. People still listen, okay? I mean, it's just sad, okay? The moral of the story is we don't want to smear the charts with our personal biases, the emotions. Emotions can be misleading, truly, okay? Could have a whole class on that. I won't go there. We want to read the chart. That's the point of being a technician. Okay, so when we look at this chart, higher high there, higher low here, and we're trying to actually get above. Now, someone might say, hey, look, I've ran out of capital. I have other trades going on. Could I try to trade this trend? Well, let's say the investor in this case said, let's show this trade, and we're going to put it all together. I'm going to go back to the trade tab. We're going to sell the 70, buy the 60. Now, wait, what does this trade look like? Okay. Now, we're going to right click on that green line. We're going to go down to where it says Analyze Trade. Now, you know what this should look like, right? You know what this is going to look like. Unlimited upside. We get it, okay? We get it. There's the long call, okay? Flat line, max loss on that long call. Let's add the other piece. Well, if you did a short, wide put spread. That sounds very advanced. But really, all it really is we're selling the put. And what we're doing in this case is we're just having a defined risk by buying the put. That's all we're doing. And that's why you see that in this case, when we actually did this trade, there is a built-in max loss. However, with that built-in max loss, you're going to see that in this case, unlimited upside. Okay? Now, as we combine this, what you're now going to notice is the theta is not as negative when you sell the put. It's going to be a little bit more negative because you're buying the put, which is theta negative. The vega is slightly vega positive. Of the four option Greeks, which one is the biggest by far? The answer, delta. So if the delta is the biggest, it's telling us we are trying to forecast, which could be wrong, a direction. Okay, now if it's positive, you think it's going to go up. If it's negative, you think it could go down. Now let's put this whole trade together and let's kind of talk about how you put on the. Now remember, the other thing about this is when you buy the put, what else do we have to know here? Well, what we have to know in this case, go confirm and send. And now what you see in this case is we're buying we're buying a put, and that adds on 65 cents. For some investors, they might say, well, that's the con potentially, but with that, does it help not tie up as much capital? Now, if we did this trade by itself, we'd probably be near $6,500, $7,000 of buying power. But since we're willing to pay for the put and the commission, that reduces the buying power, max loss, down to about $1,200. Do you think that's worth it? Do you think just for sleeping purposes of knowing, hey, if the stock went to zero, we have a locked-in defined risk trade? Some might say that's worth it. You identify that for yourself, okay? Now, what I'm going to do is send the order. So let's say the investor says, okay, James, I'm in the position and I want to set a target and a stop. Okay, well, which of these positions is bullish? Easy answer. Well, we're going to come down and say, well, we know a long call is a bullish position. Okay. We also notice that a short put is a bullish position. I'm here at the bottom. So what I'm going to do is I'm only going to put the target on the long call and the short put, because most likely the long put, that's probably going to go closer to zero. Most of those long put values at the start might be $1-ish or less, and there's a really good chance, not always, that's probably going to go to near worthless. So when we set a target, what I'm going to do is I'm going to put the target and the stop, or conditional order, on the two bullish trades. Create closing order, sell. Okay? Now when I do that, I'm going to go, let's pull back up the chart. Where's the target? If this was your trade, where would you put the target? Second question, if this was your trade, where do you see support? And where would you set the conditional order to get out? Okay, now, on this type of conditional order, we're going to say, look, exit based upon the stock. And so we're going to change limit to a market, day to a GTC. And the first thing that we're going to do here is we're going to say, look, if you go up to 80, sell, 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 get out. Now wait, if you get out of the call, you're selling the call. If you get out of the put, you're buying the put back. You're exiting, you're just going opposite to what you started the position with. Now, so we're going to put a target at 80 bucks. 80 bucks. Okay, that's going to be the target. I'm writing that down. Now, if we say, well, where do we see support? James, I kind of see support in two areas. Like where? Okay, don't keep it to yourself. Tell us. James, I kind of see support at maybe there. But I'm also thinking, could these intraday lows kind of be like an area, like a higher low? Could it be a potential level of support? Well, let's write it down. Well, if we take less 2%, now this sounds so familiar to, like, say, trend trading and swing trading. It is. But we're just using a different strategy. We're leveraging that type of trade by using a long call and a short put. So if we take 68.51 less 2%, it's going to give us, in this case, the stop price or the conditional order to exit at 67.13 if we round down. Now, we got to ask ourselves the question. You remember when we wrote down this comment and we said the trade risk? Remember that? And you were like, I don't get it. Well, let's fill in the blanks. How about we do that? Well, let's go back. What's the stock price now? 71.10. Well, if I type that in 71.10 and we say, well, what is the stop price or that conditional exit? Well, we said 67.13. 67.13. Can anyone tell me what the difference is? Well, the difference between those two, okay, is, survey says, $3.97. Type in the chat that you're with me. This is not advanced. That's where the current stock price is right now. This is where it's saying if we go to that price or less, get out. Okay, now, but the problem is that's the stock information. We're using the option. With options, we need to convert to option profit or loss by the delta. Okay? Now, so let's do this. If we go back to this position and we said on this trade, what is the delta? Well, the delta is 89. So what I'm going to do is I'm going to take that $3.97 times the delta of 89 and just multiply them. And now what you're going to see is per a one contract, what is the potential loss? Okay, $3.53. Now, James, could the loss be more severe? Yeah, it could. It could gap down, right? So you might say, look, I'm going to try to get out here, but let's say it gaps down to 65. That loss, like a swing trade or a trend trade, could have a bigger loss. However, there is defined risk, though, at some point. Now, what you're now going to notice is if we said, well, you know what, James, I can really risk $750 on my portfolio, and for every one contract is $353. So what you're now going to notice is, how many contracts could we do? Well, the answer is we could do two contracts. Two contracts, okay? So now what we're going to look at in this case is we're going to change this to two contracts, okay? Now by the way, we really want to do that as we're getting into the trade, noted, but I'm just saying, I just wanted to show application of that position sizing, okay? Yeah, so the comment came in is, what delta are we looking for the long call? The answer, probably about 55, which would probably tell us in the money, 55.60. If you pick something that had, so without even looking, we would be saying the first strike in the money. If it's somewhat in the money, the delta would probably be greater than 55, okay? So on the long call, trying to probably get that long call, 55, 65, or somewhere right in there. Not wanting to go like this because, I mean, and you'll see why later, not in this session, but if you start the position out here, you might run into a situation where it's just not trading as actively. We're also choosing the one or two strikes in the money typically because these are the ones that typically have the volume, which then affects the bid-ask spread. Now, on the short put side, what about the short put side? Answer, delta 30 to 40, okay? Probably 1 to 2 strikes out of the money. And just to recap, well, when buying the long put, what long put are we typically buying? Typically anything that has a delta of 10 or less, okay? So those are kind of re-examining the framework. Now, if we went back to this and put this on now, let's bring this up, okay? So when we actually look at this, XYZ, mark, and some of us kind of get confused by that. We're going to say, now, we got to ask ourselves the question, is that the right way? Now, we want to go the other way. We're saying, look, if XYZ is greater than or equal to 80 bucks, exit the option positions. That should be for a gain. Now, let's take the other side. Mark, less or equal to. What was that price? Well, we said 67.13. Type it in. 67.13. And now what we're going to see in this case, 67.13. And here it is. Now, again, we could run the numbers in our head. We could say, hey, look, if this stock is at $71 and we have a target up at $80, what is the stock gain? Answer, it's about $9. That's not hard. Times it by the delta. And I'm just going to take it up one. We said 89, but let's say it's 90. So we could actually already have an idea of, well, the gain should probably be around $910. If that stop was actually down at $67, let's just say even numbers, it should be negative $4. That's the stock movement. Translate that to the option. What's the delta? Well, let's say it's 90. We'll move it up one. And the loss potentially could be more, 360. Those are the numbers. And we're going to do it over and over and over and over and over again. It doesn't change. Now, the one thing I want to kind of highlight here is just real quick. I know we have about 5 minutes left. Is I want to kind of talk about just real quick is, so first off, when we talk about, let's say, the initial stop, just like the trend trade or the swing trade, setting a stop below the support, the last 1 to 3 weeks-ish, less 2 to 3%. Okay, no different. Stock over $50, less 2%. When we talk about the price target, we're looking for moves like on swing trades of 6, 8, 10% or more. We got to think that there could be some upside potential to that. Now, the stop adjustment. Well, with the stop adjustment, we could actually say, well, James, could we use, like we talked about with swing trades, like a reward to risk methodology? Sure. Could we move the conditional order up using the 8, 10, or 20-day low like we talked about? Sure. So this is where there's similarities. Now, James, what happens if maybe on that short pat, maybe we have, let's say, example given, more than 50% in the first 10 trading days? Could the investor roll the short put? Well, they roll it if they actually think that trend could continue. Okay, check liquidity. If you actually think it could go up higher, the investor might roll the position. 20 to 50 days to expiration, maybe a delta 30 to 40 as a starting point. Now, the other thing is kind of when we go back to is, so when we talk about the cash secured puts and the percentage gains or losses on the cash secured puts and the short put verticals, those percentages are the same here with the long synthetic strategy, okay? So the comment actually came in, why so bullish with a very low VIX? Well, I mean, that's kind of been the environment we've been in, right, James? James, let's be honest. There's been a lot of people that haven't been as bullish as our examples. Let's admit that, okay? So one of the things we actually look for, so what we're doing here is we put in the target, and then we actually said if it goes at or below that price, okay? Now, I'm going to kind of tell you, this is not my first rodeo. It's not my first year, my second year. I've done this for almost 30 years. And so when the VIX is low, you have a condition where the market, and so when the VIX is low, it's okay to say, hey, the VIX is low, but you want to be watching to see what type of sectors are getting a little bit of a push. In 60 seconds, let's really answer this. So number one is the VIX is low. What does that tell us about market conditions? They've probably been pretty bullish, okay? Second, if we also, let's say, look at I call this the international VIX. I've said this over and over, okay? If this chart is actually going down, international VIX, and there's reasons why I say this, you kind of have, if this chart is going down, you probably have, let's say, appetite for equities, probably bullish. I've said that, and I'll say it again. It's actually kind of been right. We'll see if that continues, okay? This chart almost flushing to a brand new low. You got to ask yourself, the question is, if the VIX is at lows, what type of sectors are we getting in terms of that are going up? Base materials smashing new highs, discretionary is actually hitting brand new highs. Are those bearish sectors? When you look at utilities, you look at staples, you look at healthcare, real estate, those more conservative areas, those are not the ones necessarily that are going to the upside, outside staples in the last 3-4 days, but it's really been the transports, technology. We said last week, keep an eye on the NASDAQ area. Could those actually growth areas be starting to actually push to the upside? If these growth areas are starting to push to the upside, even though the VIX is low, that doesn't tell us that maybe a lot of other investors are bearish as much as the investor that is maybe thinking about it is, okay? Now, I might be bearish, but other investors aren't because they're actually buying those more bullish areas. I'm out of my time here today, but I wanted to lay the foundation for these long synthetics. You'll see there's overlap in previous strategies, trends, swings, cash secured puts, and now the major difference in this strategy is the long call piece, which gives the unlimited upside. Now, I'm out of my time here today. Tomorrow, I'll actually talk about long call verticals, and then we'll talk about those two special topics next week. We got Cameron May actually coming up next. Don't forget to subscribe. Also, remember that you can subscribe for free. That way you can see all of our content as well right on YouTube. And remember that with what we discussed, it was done for illustrative educational purposes only. Your homework is to go out and actually create that sample plan if this is a strategy that you would consider for yourself in terms of practicing. With that said, this has been the class on trading with technical indicators. Thanks so much, Scott Thompson, and thanks to all of you. Take care. Bye-bye.